saying, my name is Martina Moutawakkil. I am a real estate agent with Exit Realty Associates, full-time licensed in Virginia and DC. With me, I have Brittanie Johnson. She is my partner, also licensed in Virginia. She is also with Exit Realty Associates and will be speaking later today. Then we'll have Patrick. Yep, come show us. This is Patrick. Patrick.
Savings and Trust Mortgage.
Yes, he is a lender who I have personally used many times with my clients, and all of them love him very much. Thank you so much, Pat. And then we'll have Richard. Richard Hayden is a branch manager and attorney at MBH. MBH is the largest settlement company in Northern Virginia, so we're very glad to have you here.
Very happy to be here.
Thank you very much. And we'll go on to the presentation. So the whole point today, what we want to convey to you is how to go through the process with as less bumps as possible. We want you, of course, get your dream home. So what we recommend is for you to work with a professional agent, real estate agent, like me and Brittanie. We'll talk about it in a little bit. Then most of us will need to borrow the money to purchase a home. So we'll need to talk to a lender. And once we have the pre-approval letter in our hands, we're free to go to look for your home. Once we found the perfect home for you, we'll put a contract, we'll go through all these necessary activities, get you the keys to your dream home. Okay, let's talk about agent. So why should you work with a real estate agent? Well, I think the more important question is why not? Because we're technically free of charge to you because our commission comes from the seller most of the time. So why not use us? We are professionals who work in this field day in and day out. And we can help you go through this process without, hopefully without any problems. So one thing that I want to mention is that I've noticed that buyers think that only the listing agent can show you the listing, which is not true because we all have the access to the MLS and we can all show you any property that you want to see. So don't be afraid to contact a real estate agent. So where would you go to find a real estate agent? Well, I think the easiest would be a referral, right? So you have a friend, family, someone you trust who sold or who purchased a home, and you can get that contact information from your friends, and it's the easiest path. If you don't know anybody who purchased or sold before, then you can go in person, meaning go to open house. There you can meet a person who is holding the open house. You can see if you like them, if you have a good chemistry, if they're asking questions, if they're interested in you. And you can, quote unquote, interview them without them even knowing. If you don't want to do any of these options, you can always go online. Online is more so of, online blind dating. You don't know who you're really getting, but it's an option as well. So then you would ask quickly, who are you looking for? Who is the person you should look for? In my opinion, it should be a listener and an interviewer. It's someone who asks you questions, listens to you, and hears you, knows what you're looking for, and goes more in depth, asking what you're looking for. Okay. So I will show it to you on an example. Have a sentence that I ask you to tell me what you think about if I tell you John breaks a glass, right? Brittanie, can you please check if we have any? Okay. So Brittanie, what do you imagine if I say John breaks a glass?
I hear John breaks the glass, I'm thinking John dropped a glass of water in the kitchen and it broke.
Okay, how old is John?
John is 25.
25. Did he drop it by accident or did he drop it intentionally?
He dropped it by accident because he was on his phone.
He was on his phone. Okay. Does he have blonde hair, dark hair? How does he look physically?
John is 6 feet tall with brown hair.
Okay, so we have a John that is 6 feet tall, 6 feet tall with blonde hair, 25 years old, and drops a glass accidentally, right? Because he was on his phone. Ready? Pat, what do you imagine if I tell you that John breaks a glass?
Breaks a glass. Yeah, I'm just picturing a guy holding a glass and tripping, falling.
Okay, so is he not paying attention or what is he doing? Why did he drop it? Bumping into someone?
Yeah, just not paying attention. Tripped
Not
over
paying
something.
attention. How does he look physically?
He looks like me. I can see myself doing that.
Okay, perfect. So tall, handsome, dropping or tripping and, dropping the glass, right?
Yep.
Okay, thanks so much.
Okay.
Richard, what do you imagine under the term John breaks a glass?
Well, if I hear the term John breaks the glass as an attorney, I'm wondering, does he have liability insurance?
That's a good one.
But if not, I just wonder that everything is okay, that he's not injured, that he didn't drop it because of some circumstance going
Okay.
on, and that no one else was injured. Like I said, it's always about personal injury, but also liability. And, where was he when he broke it? Was he in someone else's house or his
Okay.
own house?
Okay.
And what was their extent of the damages?
Okay, how did he look like?
John?
Mhm.
John looked like a normal person. I think you mentioned 5'11", 6 foot, might have been, aged and
Okay.
just had an issue with that glass.
Okay, just a tad little older than Brittany's example of a 25-year-old, right?
Right.
Okay.
Right.
Thank you so much, Richard.
Thank you.
So for me, if I say John breaks a glass, I can imagine a small kid, throwing a rock at a car, an accident. And you see, like, there's different people and 4 different versions of a John breaks a glass. So for me, it's the same thing if I'm asking you, if you tell me I want an updated kitchen, what does it mean? Does it mean, recessed lighting or natural lighting, open concept or traditional? Does it mean granite countertops or anything? There's so many options. So for you, it's very important to see if the agent that you're hiring as your representative is asking all these questions that he or she needs to ask. Okay, so take that from me and I'll turn it to Pat to talk about lending.
Thanks, Martina. Well, we talk to people early in the process. The first thing we're doing is, number one, just answering the questions they have. I think the borrowing of the money and the financing of real estate can be a bit overwhelming, to take it one step at a time. So first thing we're doing is pre-approvals. Okay, and what the pre-approvals we're talking about, the biggest is income. Okay, and what's this payment going to be? The loan payment, property taxes, insurance, what's this payment going to be relative to someone's income? That's the number one thing that happens in lending. A lot of times people think the loan is based on home or someone's credit. First things first is a payment relative to income. Okay, secondarily, we are looking at credit history and people's willingness and ability to pay back what they borrowed in the past. So that, that'll be credit score, it'll be length of credit history, things like that. And then just overall ability to pay. It's been a big buzzword for the last, several years. Just the issues from 10 years ago with repaying mortgages. So we just really want to make sure when we are setting up a mortgage for someone that they're comfortable, the terms, that they're going to be able to pay this without, totally stretching themselves for the length of the loan. So that's a big deal. Okay. When we talk about, and then all happens with pre-approval. When we talk about advantages of home ownership, there's a lot. Obviously, over time, if we compare someone renting relative to buying a house, it's going to be skewed numerically towards that home ownership. However, what's important and what we do with the pre-approval is we do a rent versus own analysis at the beginning, and we want people to be informed with data. What kind of equity am I building up? What is my actual tax rate? Because home ownership immediately isn't for everyone. So what I find is I think that people they hear there's There's a tax break associated with buying a home. I'm going to build some network over time. However, they don't fully have the data. So a big part of what we do is a rent zone analysis upon pre-approval to show the numbers to people so they can actually make informed and confident decisions. Okay, why buy now? Going back a little bit, as I said, it's not always for everybody to buy right now. But the important thing is we have been in this super low rate environment for a really long time. So I did some quick examples this morning. Just in the last couple of weeks, we've seen rates shoot up about 0.5%, which in a couple of weeks is a real risk rate move. So someone borrowing, the example I did this morning was $400,000. Okay, $400,000 on a 30-year loan 2-3 weeks ago was $19.09 per month principal and interest. They have taxes and insurance on top of that. But we're just going to do principal and interest. This week, with the market going up, that went up by $117 to $2,026. Extrapolate that further to say a 5% interest rate market, so from 4 to 4.5 to 5, now you're up at about $21.50. So you've gone up here by $240 if we get up to that 5% market, which relative to where rates have been in the past, 5% is actually quite low. So why buy now? If you're comfortable with the payments and ready to take that step, that math is a big reason. When you couple that with the what if scenario of we have low inventory and there has been appreciation for the last several years, if you take what if rates are 5 and what if the home appreciates by 5% and I kind of wait and dilly-dally and do it a year or two from now when I'm ready now, I'm comfortable to do it now. Well, the math on that is back just over 30 years, it's about $100,000 difference in interest you pay over time, borrowing at 4% versus 5% and also paying 5-6% more for that home a year or two from now if there's appreciation. So some requirements with loans, like I said at the beginning, the biggest thing is income. So we have to look at income, we have to look at the stability of someone's income and make sure that payment is going to fit comfortably with their income. You have to have decent credit. You don't have to have the greatest credit. You can't be totally in the dumps. So I use the word decent, and the market kind of likes to see at least a 620 credit score or higher for pretty much all the products out there. So that's a general requirement. If people are close or a little below that, what we're working towards over a 3, 6, 9, 12-month plan, how do we get them to that level? How do we get their credit up to that level for the company? Okay. From a program standpoint, it's not one size fits all. So anybody we do a consultation with, they may fit into a different program. They may fit into a few different programs. Some of the main ones that we do a lot in this area are we do a lot of better than the fairest financing. Okay. We do a lot of first-time homebuyer financing, and some of that is on the next slide through Virginia Housing Development Authority. That's a no money down program for first-time buyers. And the other very popular programs are FHA and also conventional. So when we do our consultations, we're going to outline the benefits of each program and see if you fit. Because not everyone fits in every program, and not everyone's right for certain. Okay. When we talk about optimizing credit, what we do is we see the whole spectrum of credit from perfect to really poor. So if someone's on that fringe, can afford the payment and is ready for home ownership, but the credit's a little lower, we'll run a simulator to show them if you do X, Y, Z with credit, you'll get the 10 or 20 points needed for approval. So we're doing that from someone that's on the fringe all the way to someone who's got maybe a 720 credit score and want to figure out how to get to 740 because they're seeing that the mortgage pricing is slightly bigger at that range. So it's a nice feature to have for really for anyone. That doesn't just have to be a first-time home buyer. Okay. In our area, the typical closing cost or a good factor usually closing cost is 3% of the sales price. Okay, so a quick, easy example there is if you're paying $300,000 for the house, putting no down payment to a small down payment down, you're going to be around $9,000 in costs. So prepaid, which are some taxes, insurances that you'll be paying with your mortgage. You want to talk about the VHDA? One of the programs that I just mentioned that's quite popular, especially with the first-time homebuyer crowd, mostly because you have to be a first-time homebuyer, is Virginia Housing Development Authority. Okay, so what you see here, it's really cool. VHDA is a no money down program. They even have grant money. Okay, so for some folks you fit into their grant program, they actually have free money. Okay, now it's a state bond program, so they do have some income parameters that I find really broad. So a lot of people do this. This is a chart here of based on your household size, how many people in the family and what the income can exceed. If you exceed this income, with our clients that do it, I just say you're too rich for VHTA, but there's other programs. But 125,700 for two people in the family. The next one over the 100,500 bucks. That's so that's some of the money they're giving out. And as you see, the family size increases. They go all the way up to almost 150 grand. So it's pretty broad as far as who fits in there. So VHTA is a non-profit organization that runs out of Richmond. They're in this area, and happy to talk to you and see if you fit into this. So we're a great program. That's all I have.
And one question for you.
Yeah.
What is this current rate right now?
The current rate, we've had a brisk jump up in rates. I would say the average market a couple weeks ago was about 4%, and now it's closer to 4.5%. So for 3, I think you'll see this week, Monday, Tuesday, you'll see some 30-year fixed money at 4.3-ish will be the average. So still very low, but, a brisk rise for just a couple week period.
Okay.
Very good. Hi, I'm Richard Hayden with MDH Supplement Group, and I'm ready to talk about title insurance. Title insurance is one of the costs that you'll incur when you purchase a property. A title insurance contract or title insurance is an indemnity agreement for items that defects in title that happened prior to you taking title to the property. But there's 2 different types of title insurance, and I'll go through those briefly. One is a standard policy. A standard policy covers up to events to the time you take title or close on your property. The other one is the enhanced policy, or what we call a homeowner's policy, which protects you against claims that happen after you own the property. And it costs a little bit more, but it gives you more proactive insurance. It's like more of a regular type insurance policy. The policy is optional. You don't have to buy owner's title insurance. If you're going to have a lender, if it's not a cash transaction, you'll have a lender. The lender will have lender's title insurance, and owner's policy is issued simultaneous with the lender's policy. And it's a little bit more money, about $1 more per thousand, and that protects you and your interest in the property against any claims, past, present, and then if you get the enhanced policy, any future claims. The enhanced policy is important because I think just like you have identity theft, you also have title theft that occurs now. Everything that you do with this transaction will be public record. Your deed will be public record. Your mortgage will be public record. People can come in and steal your equity. They can file false documents against the property, borrow money against the property, and then those loans go into default. If you're older and you go into an assisted living facility, people come into your house and take over your property and then sell your property unknowingly to you, especially if you don't have family in the area or someone to watch out for the property. With an enhanced policy, all that would be protected. And and understand, title insurance protects your most important investment in your life. Most people buying a house is their largest and most important investment that they're going to make in their life. And you want that protection. The lender's going to require protection, and you want that. So it says, who needs title insurance? I believe everybody needs title insurance because you don't want to self-insure. You have auto insurance, you have health insurance, you want title insurance. It covers you against any defects, for encroachments with surveys. Now, that's another issue where you do want to get a survey if it's an attached property in particular. I've gone over a little bit of what title insurance covers. Like I said, it covers against any claims, past, present, future, defects in title, unknown heirs, encroachments, those kind of things. And then, and it's important to protect, like I said, protect that interest in the property and to get the right coverage. We work with your major title insurance underwriters, and who will always be in business and will be able to protect your interest in the property. And then, so how do you choose the right coverage? Like I said, at the very minimum, get standard coverage, and not get the enhanced coverage, because I think that's more proactive. It's a slight amount more than that. And and understand also, all attorney's fees are included in the policy. If there is a claim against a property, attorney's fees, if you don't have title insurance, will be paid by you out of pocket. If you have a policy, all attorney fees will be paid. They're going to be outside of the policy limits. So you don't come out of pocket for attorney's fees. Even a consultation, just a consultation with an attorney on a title claim, whether it's a valid claim or not, would cover what the cost of the title insurance policy would be at the time of closing. Policies run for a $400,000 property, probably run in the neighborhood of about $2,000. But then you got to factor in that there's included in that would be the lender's policy. And the real cost to you is about 0.3 or 0.4% of the total purchase price on the property. So it's not a significant cost. It certainly is significant protection for you. You want to protect your investment for you and your family. You want to have it, and you want that peace of mind that you're going to, that if anything happens, you're protected and fully protected and covered with all claims. Okay, so thank you very much. I appreciate the opportunity, and turn it over to Brittany.
Hi, everyone. So my name is Brittanie Johnson, and I'm going to talk to you about your home search. So piggybacking off of my partner Martina earlier, talking about why it's important to use a realtor, one of the things that we do for you is get you the correct information when it comes to searching for your home. Nowadays, there are so many different platforms out there. There's Zillow, there's Realtor.com, there's Trulia, there's Redfin. There are all these different avenues where you can find information on home sales. But the problem is, many of those platforms do not have the correct information. They do not have real-time information. They do not have the price updates. They're not going to show you true market value. They're not going to give you all the information necessary to make a smart and informed offer on a property. That's where we come in as your agent. We're going to do an analysis. We're going to see what homes in the neighborhood are selling for so that you're not overpaying for your house. You're also going to know if you're getting a great deal and if it's something that you really need to jump on because it's underpriced. Maybe it might go a little quicker. We're going to negotiate a seller subsidy for you. What a seller subsidy is the seller's contribution to your closing costs. So earlier, Pat talked about closing costs, and in general, you can use a 3% of the home's value to calculate your closing costs. Well, that may be a lot of money. In the example he gave, a $300,000 home, you can count on about $9,000 of that to be closing costs. Closing costs are some of the things that are going to take care of your taxes and insurance that are needed to be paid up front, that first month's payment, some of your title insurance is wrapped up into those closing costs. That can be a hefty out-of-pocket amount for some people. So we as your realtor are going to negotiate for the seller to help you pay for some of that. So maybe we can get 1.5% covered by the seller. For example, that would be $4,500. Then your out-of-pocket would be significantly reduced because the seller is going to pay some of your closing costs as part of the deal. These are the types of things that we can negotiate for you. It is in our best interest to make sure that you have the best possible negotiating terms out there. And we do that by comparing the market value, seeing what other homes are going for, and doing substantial research before you're going to be making an offer on this property. After all, buying a home is one of the biggest purchases of your entire life. You don't want to overpay for a property. You want to make sure you're getting a good deal, and you want to make sure you have a little extra money in your pocket. When you're buying a house, you don't want to deplete your savings account. So we're going to make sure we have some seller subsidy in there if we can get it for you. Also, we're going to do a competitive market analysis. What that's going to do is, again, comparing it to homes in the neighborhood to make sure you're not overpaying. For example, 2 homes right next to each other, they both have 3 bedrooms, 2 bathrooms, and a basement. If one is priced at $325,000 and the other is priced at $400,000, there's obviously a big gap there. Something is missing. Why is this one $75,000 more than the one that's right next to it? That's an example of where we're going to say, you have to justify that $75,000. They both have the same bones, 3 bedrooms, 2 baths. What makes this one $75,000 more? We're going to make sure we negotiate that stuff for you. Talk to the sellers about making sure you're not overpaying for the property. Once we find the house, that's great. You found the right one. We're going to submit your offer. The Virginia sales contract is 16 pages long. If you have any idea how cumbersome that can be for a new home buyer, that can be very stressful. We're going to go through all the ins and outs of the contract and submit your offer and get it to ratification. What is ratification? Ratification means that both sides of the property, both sides of the parties of the contract come to an agreement. So the sellers have agreed to accept your offer and the buyers have agreed to submit this offer. You both agree on the sales price, you both agree on all of the terms, and you are now ratified. Ratified means we can proceed with the other contingencies that are going to be put in place to protect you during this home buying process. Contingencies are things that must be met in order for the contract to continue moving forward. For example, there's going to be an earnest money deposit. Earnest money deposit shows the sellers that you're serious about purchasing their home. It's typically about 1% of the sales price. So for example, on a $300,000 home, you would write a check for $3,000 that would then be credited towards your closing costs at the end. That shows the seller that you're serious about buying their home. There's going to be a home inspection where someone is going to come in and check that home from top to bottom to make sure that you're not getting a defective home. They're going to tell you the age of the services in the home, for example, the furnace, the water heater, stuff like that is all going to be checked out to make sure it's all working properly. There's going to be an appraisal. That's going to be required by the lender. The lender has to know that this house is really worth $300,000 because if they're going to loan you the money, they have to know that it's worth that money. There's going to be financing. You have to make sure you can secure the loan. Is your credit good enough? Do you have the amount of down payment? Can you afford the monthly payments? Those are the things that Pat, as your lender, is going to make sure we can meet. There's going to be a final walkthrough. If there were any problems that needed to be corrected from the home inspection, we're going to make sure those things are done before you take ownership of that home. And then we're going to go through the closing process where we sit with Richard from NBH and talk about transferring ownership. You're going to sign your deed. You're going to find out exactly your title coverage, and you're going to become the new owner of that home. Those are the different steps. Thank you so much for tuning in. I know we have a couple of questions that we need to answer. Pat and Richard, if you all could come back. Richard, one of the questions was, is title insurance an option?
Yes, title insurance is an option. You don't have to pay for it. But like I said, for example, for $200,000 property purchase, the policy would be about $2,000. $1,200 of that would go towards the lender's policy. So then your owner's policy would be about $700 to $800. So maybe $2 a thousand, and of that $2,800 would cost, like I said, about an hour or 2 hours with an attorney to consult on a claim. And unfortunately, I know this comes as a shock to some people. People do bad things. They steal title, they steal equity, and you want to protect against that. You want to protect against theft and protect against any past defects. So it's a nominal cost that you're already incurring most of the cost for the lender policy, and I would highly recommend it. Otherwise, you're self-insured and you're on your own. So any claim will be out of pocket.
So Pat, we have a question. Would it be harder to acquire a loan for a land?
Would it be harder to acquire a loan? Yeah, I'd say so. There's less, put it this way, banks are less willing to lend without a roof or dwelling, a house, and property. So usually a little bit more down payment, a little bit more down payment. Just don't do land lending. What I've seen is 65% of the value. So $100,000 main loan, 60.
Okay. Okay. Another question for you, or mostly for you, the question. So how can I get access to the income and credit guidelines?
The income and credit guidelines, well, the loan officer should be able to help you with that. But I mean, Google's pretty effective. So you can look up, Fannie Mae has thousands of pages you can go through that are under there that train up the match guidelines. FHA has a handbook about the stick. You can do that too. So, or you can just ask us.
Yeah.
And we will get you the
We
exact
can help
answer
you
you're
and maybe
looking
even
for.
show you the answer to that particular question.
Okay.
It would be,
So we have another question for Rosa. How many times can I use my VA loan to purchase a house? That's a good question.
good question. We get it a lot, especially in this
Yeah.
area. Isn't a VA loan? It's just if you have one on another house at the same time, it's going to restrict some of your entitlement. So a common misconception is I can only have one VA loan at a time. That might have been the case at some point.
Mhm.
It's not the case now. It's just that some of your entitlements going to be used up, so you may need a down payment. VA loans don't necessarily require down payment all the way up to $679 grand in our area. If you got a VA loan down the road and you want to move, I can guarantee you won't be able to finance the whole thing. So we just have to talk about that and see if you need to sell first, sell second. But if
Okay, do you have any other questions that I wrote for you?
fixed or adjustable?
Yes, fixed or adjustable. Okay.
Yeah, we actually, one of the questions was on fixed rate or adjustable. Both are options. With rates being so low the last 5-7 years, most of the business that was written was fixed. Okay. As they go up, this trend continues. You'll see consumers deciding to use more arms. You'll see arms being structured. You just have to, what I usually recommend with the arms are fine. You just have to make sure you're okay. I want people to save the difference. If it's going to save you $125 a month, just save that for 60 months, the 5-year period, because it's going to adjust. You don't want to assume it's going to adjust lower. So I think that's where some people made it. Don't totally use an arm just to qualify for a bit of pounds. You may be stretched later. But if you use it as a financial planning tool, you can do some damage.
Okay.
Assistance for closing costs. I think Brittany
Yes,
covered that a little bit.
We covered it a little bit, yes. If you have any questions as far as that, we can, as a team, help you get any assistance you might need or qualify for. So don't be afraid to contact us. Our contact information, all of us, is going to be in the descriptions. We're going to save this video so you can replay it as many times as you want. If you have any questions, don't hesitate to pick up the phone and give the call. Thank you so much for joining us today, and we look forward to doing this again sometime soon. Thank you, Richard.
Thank you, Richard.
Thank you.
Thank you guys for tuning in. If you have any other additional questions, feel free to continue commenting on this video. We will be checking the comments and reaching out to you to make sure we get your questions answered. Thank you so much for tuning in. See you next time.